Hello, everyone. Welcome to another episode of Dollar Dialogue. Today's episode 36, Inside the Stock Market Engine, exploring the S&P 500 and Index Fund with Mr. Supreeth Nagella. Mr. Supreeth Nagella is a high schooler in Dhaka, Bangladesh. However, he is originally from Bengaluru, India. He is very much interested in the topic of finance and especially the importance of studying the stock market and learning more about S&P 500 and index funds. He's very much interested in those topics. Mr. Supreet Nagella, welcome to our podcast. Is there anything that you would like to add to the introduction that I've just said?
No, thank you very much, Mr. Araf Malik. Thank you for inviting me and having me over. I'm very excited to talk about this topic today.
You are welcome, Mr. Nagala. Now let's talk about the stock market. The stock market functions as a platform where investors buy and sell ownership, or known as stocks, in publicly traded companies. It is influenced by supply and demand, economic conditions, interest rates, and investor sentiment. The major stock exchanges include the New York Stock Exchange and Nasdaq. The S&P 500 is a global stock market index that tracks the performance of 500 of the largest publicly traded companies in the US. It also serves as a benchmark for the overall health of the stock market and economy. Companies in the index are selected based on market capitalization, liquidity, and financial stability. The S&P 500 is a market cap weighted index, meaning larger companies have more influence on its movements. The top sectors include technology, healthcare, financials, consumer discretionary, and communication services. The major companies in the S&P 500 often include Apple, Microsoft, Amazon, Google, and Tesla. Historically, the S&P 500 has provided an average annual rate of return of about 10% over the long term. It experiences fluctuations due to economic cycles, inflation, interest rate changes, and global events. They also bear the bear markets when there's a decline of 20% or more, and the bull markets when there's certain growth are natural phases in its performance. Again, an index fund is a type of mutual fund or exchange traded fund (ETF) that aims to replicate the performance of a specific market index. It also has a very passive investing approach. These funds track an index rather than actively selecting stocks, and they also have lower fees and costs compared to actively managed funds due to reduced trading activity. So, is there anything that you'd like to add to the introduction about the index fund and the S&P 500, Mr. Shazib Kari, Mr. Arif Malik, and Mr. Supri Nagala? Mr. Shazib Kari, my hand is raised. Would you like to add anything?
Yeah, sure, Arav. So I think you gave a really nice description and introduction of our topic, and just to add on to the basics, I'd say that the S&P 500 is essentially a stock market index that tracks the performance of the 500 largest publicly traded companies in the U.S. And it's also considered as a benchmark for the overall stock market because it includes companies across different sectors like tech, healthcare, finance, consumer goods, and so on. So I'd say that you can think of this as a thermometer for the economy. So you could say that when the S&P 500 is up, it usually means companies are doing well, and when it's down, then investors kind of get nervous when they see that. And adding on and talking about the index funds as well, this is where like the S&P 500 goes from being just a stock market benchmark to an actual investment strategy, because index funds index funds are basically baskets of stocks that mimic the performance of a market index, like the S&P 500. And instead of picking individual stocks, like should I buy Tesla or should I buy Apple, you're buying a little piece of all 500 companies in the index. And the best part of it is it's passive investing at its finest. You're not constantly buying and selling stocks. You just invest in the index and let it go over time.
Wow, Shazib, that was such an interesting explanation by you. But the S&P 500 is a topic we talk about all the time. But I want to question something, and it's a very rare question that we rarely question. So on the news, in financial reports, and in casual conversations, we always hear the S&P 500 is up today, the market is down today. Invest in the S&P 500 and you'll be set for life. It's treated like the ultimate scoreboard of the economy. If the S&P 500 is up, people celebrate. If it's down, panic spreads. But let's take a step back and really think about this, at least in my point of view. Why do we trust the S&P 500 so much? Is it really the best representation of the economy? And does it truly show us what's happening in the American business? Or have we, without realizing it, been conditioned to accept it as the economic barometer when in reality it's just a small, carefully curated slice of the corporate world? Okay, so the S&P 500 is an index as already exemplified by Mr. Araf Malik. It tracks the 500 largest publicly traded companies in the US based on market capitalization. It's considered a diversified mix of industries: tech, healthcare, consumer goods, finance. But the main problem here is it's not the whole market. So let's put this into perspective. The US has over 33 million businesses, and only about 4,000 of these are publicly traded on major exchanges. And of those 4,000, only 500 make it into the S&P 500. So while it feels like a broad, all-encompassing measure, it's actually just a fraction of the business world. Now think about that. Can an index that only tracks 500 handpicked corporations really represent the entire US economy? Maybe not. So here's where things get interesting. Let's talk about what the S&P 500 it doesn't include, because that's just as important as what it does. The S&P 500 is all about big business. But what about the millions of small businesses that drive economic growth? Think about this. Small businesses account for 40% of US economic activity. They employ nearly half of all American workers. And small businesses are the birthplace of new innovation and competition. And yet, not a single one is represented in the S&P 500. So when the index is up, does that mean small businesses are thriving? Well, not necessarily. In fact, they could be struggling while the top companies continue to soar. And that's exactly what we saw in 2020. Let's go back to March 2020. The world was shutting down, businesses were closing, millions of people were losing their jobs. But guess what? By August 2020, the S&P 500 had completely recovered and was hitting new all-time highs. How is that possible? Because the S&P 500 is dominated by mega cap tech companies: Apple, Microsoft, Amazon, Google, Facebook, Nvidia, while the rest of the economy was collapsing. These giants were thriving in a remote work world. For instance, small businesses struggling, small restaurants closing their doors permanently, and travel and hospitality, they were crumbling. But none of that was reflected in the S&P 500. If it was as if we were living in two different realities. One where everyday people were suffering, and another one where the stock market was celebrating. And that's when it hit me. The S&P 500 isn't just the economy. It's a very selective scoreboard for corporate America's biggest winners. So we also hear the idea that S&P 500 is very diversified. But I feel that we should challenge that, because the S&P 500 is a market cap weighted index, meaning the largest companies hold the most power. And right now, the top 10 stocks make up over 30% of the index. Apple and Microsoft alone, over 13%. So when you invest in the S&P 500, we are getting exposure to the big 500 companies, but I feel that what we are actually doing is just making a giant bet on the top 10 tech giants. That's something to really think about. So, after this discussion, I also have a few questions for all of you. Is there an indicator more reliable than the S&P 500? And are we too focused on stock prices while ignoring real economic health? And finally, are we all just buying into a system that was never meant to show us the full picture?
Yeah, I think Supreet, you asked a very good question, and I think you're really on point there. That the S&P 500 may not be as diversified as we might think, as they have invested in mostly the monopolistic tech companies in the U.S. market. But I think it's also important to realize that the S&P 500 are profit maximizing firms. So what they do is obviously they're going to invest in the top. In the companies with the with the largest market capitalization, but they're also looking at the companies which have the most growth potential, and also the companies which have which really helps the investors in terms of what we are paying for. So if the investors are paying for like $100, they might get 100% of their returns back, or at least 50%. So, and that just happens to be a coincidence that most of the tech companies fall into this category. So I don't think S&P 500 is necessarily only looking at tech companies. I just think that tech has so much prospect, so much potential that it just happens to coincide. And I do agree with the notion that it's mostly large cap companies, but obviously S&P 500 is going to look at the big companies. So I would say for more comprehensive US indices, Wilshire 500 is a good one, which includes nearly all publicly traded US companies, around 3,500 stocks, and offers a broader market view. And there's also, I believe, called a US index called the Russell 3000, which covers 3,000 of the largest US stocks, including mid cap and small cap companies, making it more representative than the S&P 500. And for global indices, I think it's better if we look globally, not just the US. Globally speaking, there is a very awesome index called the MSCI World Index, which tracks large and mid cap stocks across 23 developed markets, providing a global perspective. And there is also other S&P 500 called the S&P 500 Equal Weight Index, EWI, which gives equal weight to all 500 companies, preventing dominance by large cap trade stocks. So I think even though the S&P 500 is very good in terms of giving back ROI, and S&P 500 is basically what we look as a benchmark in the stock market, there are alternatives. And I think for the viewers out there and also for the audience, it's better if we not only diversify not only diversify our stock approach through buying indexes, but also diversify our indexes through buying a ton of them, so that we can ensure that our profits are relatively stable and maximizing while we can minimize the losses. So what do you guys think?
Yeah, Arif, I think what you said is, I think you spoke pretty well. And I really agree with you. And first of all, Supreet, what you were talking about, it was really interesting. I think you brought up some really interesting points, and then you also brought up like really interesting questions that we could think about. And then Arif, I think you answered really well, and you had some really insightful thoughts. And I think adding on to you guys, like I would agree with you guys basically, because like while the S&P 500 tracks large US corporations and mainly the monopolistic ones, like you said, Arif, there are also other indexes that might provide a different or broader view, you know, like there's one called the Russell 2000, which is like, which tracks small cap stocks. And this index is important because small businesses drive much of the job creation in the US. And if the Russell 2000 is struggling, it may signal trouble for the real economy, even if the S&P 500 is high. And then there's also other ones like the Buffett indicator, which was actually created by Warren Buffett. And this indicator compares the total US stock market value to GDP. And if the stock market is way higher than the GDP, it signals overvaluation and potential bubbles. And right now, the Buffett indicator suggests that the US stocks are historically expensive compared to the economic output. And you know, like stock prices are not the real economy. Like Supreet, you brought this up, and I agree with you because there are also other key indicators that reflect the real economy. Like for example, the unemployment rate. The U.S. unemployment rate is a direct measure of economic health. If unemployment is rising while the stock market is booming, we have a disconnect between like Wall Street and Main Street. And there was also another interesting like video I was watching where it was like comparing China's economy and US's economy, and we could see how like their China's income inequality was getting like uh it was decreasing, and whereas US's one was just increasing. So that was pretty interesting to me. And we could also look at the GDP growth, obviously, which measures the total value of goods and services produced. And if like hypothetically, if the GDP is shrinking but stocks are rising, it could indicate a bubble. And there's also other factors like corporate debt levels, because many S&P 500 companies use debt to boost stock prices, which can create artificial stock market gains. And if debt gets too high, a crash can happen fast.
Shazib Kareem, what an interesting, insightful explanation from you. But now, since we have discussed some alternatives to S&P 500 as well, uh, some what's it called, historians who study the past industrial revolutions believe that we are currently sitting at the brink of the fifth industrial revolution. So let's break it down. For decades, the S&P 500 has been considered the heartbeat of the US economy. It's a collection of the most powerful and influential companies driving American business forward. But these days something has been shifting. The biggest forces in the market aren't oil giants, banks, or industrial manufacturers anymore. They are AI driven tech companies Nvidia, Microsoft, Google, Amazon. Artificial intelligence isn't just shaping industry, but it's also reshaping the entire makeup of the S&P 500 years itself. So here are the big questions. Is AI fundamentally changing what it takes to be a top company in the S&P 500? Are we witnessing the rise of a market where AI dominance is the only path to survival? And if so, is the S&P 500 still an accurate reflection of the economy or just a reflection of who controls the most AI power? Okay, so think about the S&P 500 20 years ago. The top companies were General Electric, ExxonMobil, Citigroup, and Walmart. And now the landscape looks completely different. Microsoft, Apple, Nvidia, Google, and Amazon. But what do all of these new companies have in common? They are the forefront of AI innovation, excluding Amazon, of course. But Amazon has also started transitioning into cloud-based technology and is also looking into investing in AI to keep its stronghold in the S&P 500. So moving on, companies that build AI, use AI, or sell AI-powered products are also seeing explosive growth, while traditional industries are struggling to keep up. Nvidia, the world's leading AI chip maker, saw its stock price triple in 2023 alone, propelling it into the S&P 500's top 5. Microsoft is integrating AI into every product, from Windows to Office to cloud computing, driving its market cap past $3 trillion. And Google is pouring billions into AI research, ensuring that they remain dominant forces in tech. So this isn't just a tech trend, it's an AI driven economic power shift. And here's also a wild part. Right now, seven companies alone, as I already mentioned, make up over 30% of the entire S&P 500's value. And this means a massive portion of the index is dominated by AI driven companies. So what I believe is that if AI continues to dominate and companies that don't adapt to AI, they might start disappearing from the S&P 500 altogether. And this leads me to believe that we might be headed toward a future where the S&P 500 is 80% tech and AI. And if it does go on in the same path we're going in, what would happen to industries like energy, retail, or healthcare if they aren't able to keep up with AI?
Arif, I see your hand is raised. Would you like to add anything?
I can add if necessary.
Yeah, Shazib, I believe
Well,
Arif is facing internet difficulties.
yeah, so I think Supreet brought up a really interesting point about like how some people say we're currently living in the fifth industrial revolution, and and I totally agree with that, Supreet, because you know, like there are a lot of signs because AI is no longer just a productivity tool, but like a creative partner, and companies are shifting to sustainability first strategies to combat climate change. And there's also ethical AI, responsible innovation, and AI governance. They're all now global priorities. And you know, and you also brought up a really interesting point, Suprit. Like, what would happen to other industries or sectors if they're not able to keep up with artificial intelligence? So, like, I'd say that industries that fail to adapt to AI will face severe disruptions, and some could even collapse entirely. We've already seen AI-driven automation reshape jobs, but as AI continues evolving, the gap between tech-driven and lagging industries will widen dramatically. Because we've seen how powerful AI can be, and I think it has much greater potential. Because and you know, industries that fail to integrate AI will, I think they'll experience like major consequences, like such as like increased cost and efficiency, because businesses that don't use AI for automation will have higher operational costs and lower profit margins. Like, for example, AI powered robotic warehouses reduce costs for Amazon, but old school retailers still rely on manual inventory tracking. And there's, it would also cause like job losses. Like, for example, workers in non-AI driven industries could lose jobs as companies fail to compete. Like, for example, traditional taxi services lost billions because they couldn't compete with AI driven ride sharping apps like Uber. And like, if you asked me like which industries are most at risk, I'd say manufacturing, because AI powered robotics are replacing human assembly lines, and companies that fail to automate will struggle with higher labor costs and inefficiencies. Like, for example, there's Tesla's AI driven gigafactories versus the traditional car manufacturers.
Thank you, Mr. Shazib Karim, for your opinions. And moving forward, I think that it's also important to talk about the reason people invest in S&P 500. I think it's mostly because of diversification, because it provides them exposure to 500 companies across various sectors. There's also a lower risk when it compared to individual stock prices, and there's also a lot of consistent performance, including long-term track record of growth. Moreover, I believe that low fees, again, as I said, there's expense ratios for S&P 500 ETFs are typically below 0.10%. And talking about some of the other ETFs, some of the other ETFs that we know are the SPDR S&P 500 ETF Trust, one of the first and most traded ETFs. And there's the Vanguard S&P 500 ETF, who low cost ETF alternative. There's also the iShares Core S&P 500 ETF. This is also another low cost index fund. And there's the Fidelity Zero Cap, a large cap index fund, which has a no expense ratio for cost conscious investors. And I think it's also very important to talk about the active versus passive investing. I think through passive investing, through index funds and ETFs, there's lower fees, long-term growth, and there's minimal management. While with the active investment, there's a lot of mutual funds. There's also stock picking, which includes higher fees, potential for outperformance, but it also increased risk. And many studies show that passive funds are outperform active funds over long periods due to lower fees and market efficiency. And there's also risk and challenges of index investing. There's a lot of market volatility. While diversified, the S&P 500 is still subject to downturns, and there's also no downside protection because unlikely actively managed fund that may shift allocation. And there's also a lot of concentration risk as the index is heavily weighted towards tech giants, which can lead to sector specific risk. So, what's your opinion on the new information, Mr. Arif Malik, Supreet Nagala, or Mr. Shazib Karim?
Oh, could you please repeat the question, please?
What's your opinion on the new information that I provided?
Oh, yes. Okay. So when you said that people use the S&P 500 for passive income and for like investing, I realized that the rich don't use the stock market the same way we do. For instance, what if I told you that the S&P 500, one of the most powerful and influential indexes in the world, is being used by the ultra wealthy to legally dodge taxes? And the truth is, the rich have figured out how to game the system. They're not just investing in stocks, but they're using the stock market as a tool to avoid paying their fair share in taxes. So let's break this down because this is where it gets wild. Let's first start off with the capital gains taxes. When you sell an asset like stock, the government takes a cut of the profit you made. This is called capital gains tax, and it varies depending on how long you've held the stock. If you have held your stocks for over a year, you pay long term capital gains tax, which is generally lower than the ordinary income tax rates. But if you sell within a year, you're hit with short term capital gains, which can be as high as 37%. Sounds pretty standard, but here's where the rich get clever. They don't sell. They don't sell at all. Instead, the wealthy often take loans against their stock holdings to access the money they need, avoiding capital gains tax altogether. So, why sell the stock and pay taxes when you can just borrow against it? This is the mindset of the wealthy. This is the this is the big loophole as well. Let's say you're sitting on millions of dollars in Apple stock, for example. If you still sell those shares, you're paying taxes on the profits. But instead, many wealthy individuals don't sell their stocks. they simply borrow against them. Stock based loans are offered by banks at low interest rates, much lower than the capital gains tax they have to pay. They can borrow against the value of their holdings, access cash, and avoid taxes entirely. The loans are often never paid back because they can just roll the loan over with more stock. So essentially, the rich can live off their stocks without ever having to sell them, which means they avoid capital gains tax, inheritance taxes, and many more. Now let's talk more about the S&P 500 as well. We have also sorry, let me repeat. Let's talk more about the S&P 500. The ultra wealthy will often invest heavily in these stocks because these stocks not only appreciate in value but also pay dividends. And instead of cashing in on these dividends, they reinvest them, compounding their wealth while simultaneously avoiding taxes. But here is where the real question for me is instilled. How is it that the wealthy can build multi generational fortunes while the average investor is stuck paying capital gains taxes on their meager stock sales? Is the system rigged to reward the ultra wealthy while the rest of us get stuck paying the bill?
Yeah, Supreet, I think what you asked is a very interesting question. And even though the stock market might not be explicitly rigged against the ultra rich, I do think that it's undeniable that it is structured in a way that that favors the wealthy and institutional investors. Because first of all, there's something in economics that we learned about that Mr. Spivey taught us. It was about asymmetric information, and it's basically when one party has more information than the other. And in the stock market, the same can be applied. The wealthy people, of course, they have their connections with other firms, with other brokers, and basically people in the higher ups in the stock market. So they have information that the general public doesn't, which is why the wealthy people usually they are smart with their money in the stock market, and they can maximize their ROI in a way which normal investors can't. And this is even though this might be like insider trading, it's really a legal gray area, because it's not technically insider trading if wealthy people get the information from not really from their family members but through someone else, and they often find loopholes to do this. And also it's important to understand that retail investors or the normal people who invest in the stock market often get hyped into the bubble. For example, the meme stocks, cryptomanias, etc., while rich people and other institutions exit early with profits. And so there's a psychological behavior as well, which most retail investors have, that rich people doesn't, or also wealthy people don't have. And also, I think the capital gains tax that you mentioned was interesting, because according to the U.S. federal tax codes, you can technically bet against your stocks for carrying out loans with lower interest rates, which is what the ultra wealthy actually do. So they actually don't sell their stocks, and even though they do it in not to not pay capital gains taxes as a whole, it still is just disproportionately benefiting them. And also because of this, I think the average Joe doesn't get their fair share of the deal. Lastly, I would like to also say that other than that, the wealthy people also have preferential treatments in IPOs, international initial public offerings, which are often allocated to wealthy investors and institutions first, which is why I think the market is indeed rigged. Not rigged, but I would say the market favors the ultra rich than the poor. And if from your lens, you could see that as potentially being rigged, but I would say it's not technically rigged. I would say it's more of a favoritism thing, in which the market and the people who run the market often help ultra rich get even richer.
Mr. Shazib Karim, I see your hand is raised. Would you like to add anything?
Yeah, yeah, sure. So, first of all, yeah, I think Supreet, you were talking You brought up some insightful thoughts on like on whether the system is rigged for the rich so the rich can get richer and the poor can get poorer. And also, Arif, I completely agree with your points about like asymmetric information, as we did learn in our econ course. But I think like the system might actually be rigged for them because like once a person is wealthy, they can use their money to make even more money while the poor spend most of their income just to survive. Like for example, corporations often buy back their own shares, driving up stock prices, which disproportionately benefits wealthy shareholders. And wealthy individuals live off dividends, rental income, and interest, while most people rely on active labor. And if a billionaire earns just 5% on their wealth, they can make millions a year without working. Meanwhile, working class individuals struggle to save or invest due to high living costs. And also, the wealthy and large corporations have direct influence over economic policies through lobbying and campaign financing. Like billionaires and corporations spend hundreds of millions of dollars lobbying Congress to pass business friendly tax laws, labor policies, and financial regulations. And the richest individuals fund political candidates who will protect their interests, whether it's tax cuts, deregulation, or subsidies. And large corporations often push legislation that discourages competition, allowing them to remain dominant. And this makes it really difficult for for new businesses and lower income individuals to challenge existing power structures.
Hi, Arif. I see that your hand is raised. Would you like to add anything?
Yeah, I would like to make another point regarding influence over regulations and policies. So, the wealthy investors in the US, primarily speaking, wealthy investors and large financial institutions do this process called lobbying, in which they sort of like impact policymakers to sort of create favorable policies in their favor. For example, agencies like the SEC, the Securities and Exchange Commissions, are often led by former Wall Street executives, leading to a light enforcement on financial elites while small investors face stricter rules. For example, in 2021, retail traders driving up GameStop stock were restricted from buying on platforms like Robinhood, allegedly due to pressure from hedge.
I believe that Arif's internet has cut off. Yeah, he's back. Arif, would you like to continue adding your information?
Yeah, apologies. The internet was off. So yeah, basically they create favorable policies against the ultra rich, which basically is a problem because not only is the stock market rigged, then the government is also rigged because, and I don't want to sound like a conspiracy theorist here, but the SEC, which is a governmental agency, it does even though it tries to stay impartial, it does impose favorable policies against the ultra rich, like the GameStop example that I mentioned, which is also recent in 2021. Also, the market there are also cases of market manipulation through derivatives and short selling. So what happens is that hedge funds and institutional investors use complex financial instruments like options, swaps, and futures to manipulate stock prices. And sometimes there's this process called naked short selling, where shares are sorted without being borrowed, and this can artificially drive down prices, hurting retail investors. For example, during the 2008 financial crisis, big players shorted mortgage backed securities while still selling them as safe investments. So the rich did get richer, while the poor people or the average Joe or the retail investor had to suffer. Additionally, there's this thing called front running, in which is done by high frequency traders. So high frequency traders or HFT firms use advanced algorithms and faster connections to execute trades milliseconds before retail investors, profiting from tiny price differences. For example, a retail investor can place a large buy order and the HFT, or the high frequency trader or high frequency trading firms, can detect it. Then they buy the stock first and sell it back at a slightly higher price, profiting at the retail traders' expense. And I think Michael Lewis's book Flash Boys exposed how HFT firms take advantage of everyday retail investors. Additionally, I would say, other than that, I've already talked about media manipulation, market sentimental control as well. But I would say there's also stock buybacks favor for the wealthy. Companies, for example, spend billions on stock buybacks, which inflate the share prices but don't directly benefit workers or small investors. So, what can happen is executives and wealthy shareholders who own most of the stock see their wealth rise as buybacks artificially boost stock prices. For example, if my memory serves me correct, Apple spent 90 billion on stock buybacks in 2023, enriching shareholders while wages stagnated. So this just goes on to show that the market is indeed rigged. But I do think while the stock market favors the wealthy through systemic advantages, through the government and through the market, retail investors can still succeed with it. For example, Warren Buffett, he didn't start super wealthy. He was an everyday retail investor, but he sort of cracked the code of the stock market in which he took the long term route. Uh, and if I'm not mistaken, Warren Buffett wasn't. He became a millionaire at age 30, a billionaire at age 50 or above, and then he became like multi-billionaire at like age 60 and 70, which just goes on to show that Warren Buffett, did crack the code, but it did take him like almost his entire life, almost 70, 80, almost 70 years for him to become a billionaire or become extra successful in the stock market. So I would say long term wise, retail investors can succeed through just understanding how market works, how company works. They can analyze it, and through that they can make money in the long term. But I would say in the short term it's quite difficult, because short term wise it does seem, the based on our analysis and discussion, that the market is rigged to some extent.
Ari, when you started talking about all the market buybacks to artificially augment the price of stocks, I also got a bit intrigued into one of my ideas that I was thinking about quite a few days ago. So we like to think of the S&P 500 as a free market in action, a collection of the 500 most successful companies in America, driven by competition, innovation, and consumer demand. But what if I told you that I really don't think it's the full story? What if the S&P 500 is uh, propped up and supported by the government in ways that we don't even realize? What if certain companies aren't in the index because they're the best, not because they're the best, but because they have deep political and financial ties? And what if this whole system is just one giant self sustaining illusion where the government, Wall Street, and corporate giants work together to keep stock prices inflated at the expense of the uh, average person? So most people think of the stock market as a reflection of the economy, but in reality, I believe that the S&P 500 is heavily influenced by the US government. How? Let's break it down. To start off, bailouts and corporate welfare. When things go bad, who gets saved? Big banks, massive corporations, and industries that are deemed too big to fail. This keeps failing companies alive and artificially props up stock prices. How about the Federal Reserve's role? There are low interest rates and trillions of dollars in money printing, and there is constant intervention to inflate stock values. How does this happen? Because because the government allows companies to borrow money at near zero interest rates, which the companies don't use to create jobs or invest in innovation. Sometimes they instead just buy back their own stock, driving prices higher while real economic productivity stagnates. So this makes me wonder and more intrigued into the rigged game. Who really gets into the S&P 500 and who is the most successful? Okay, so people assume that the S&P 500 is made up of the best performing companies, but here's the reality. The selection process depends heavily with the companies and their ties to Washington, the Federal Reserve, and financial institutions. And I believe that they get unfair advantages. And let's be real, if a company is too politically inconvenient, it really might never make it in, no matter how profitable it is. So, is the S&P 500 really an organic reflection of American business, or is it just a hand-picked list of government-favored corporations? But wait, why does the S&P 500 keep hitting all-time highs while wages barely move, debt skyrockets, and inflation destroys buying power? If the market truly reflected economic strength, we wouldn't see record stock prices during recessions, record stock prices, for instance, during COVID 19, right after COVID 19, and the stock prices skyrocketed. And there are also mass layoffs while CEO bonuses grow, and a shrinking middle class while billionaires and uh, add trillions to their net worth. Maybe it's because the market isn't just the economy, it's a wealth transfer system for those who know how to play the game. Well, here's where things get more interesting, according to me, because here's an interesting example for us to consider. Very recently, we had the US elections, and when Trump won the election, Tesla's stock skyrocketed. And this meant Elon Musk became way wealthier. He gained over $200 billion after Trump's election win. But why is this? Because investors bet that Trump will loosen regulations, cut taxes, and be more pro business, especially for his Doge friend Elon Musk. And in addition, once an election is over, the markets adjust quickly to the expected policies of the new leader, and Trump's policies tend to favor big corporations and high growth tech stocks like Tesla. So, you see, after this election, Musk didn't invent a new product overnight. He didn't expand Tesla's production. He didn't revolutionize AI in a single day. But yet, his net worth jumped by tens of billions of dollars. And all of this was because of a political event. This is where the game is rigged for the ultra wealthy. Musk doesn't need uh, to sell his Tesla stock to access his wealth. He can simply borrow against it tax free, as I already talked about earlier. But that gets a bit too specific. I think we should zoom out a little bit. So if a single election can cause stocks to surge and billionaires to get so much richer, doesn't it raise some bigger questions? Are companies in the S&P 500 truly successful on their own, or do they rely on government policies and political shifts? If the stock market is supposed to reflect the economy, why does it often move in the exact opposite direction of real wages, job losses, and financial struggles? And most importantly, if the wealthiest people like Elon Musk can use elections to multiply their fortunes, what does that say about the final financial system as a whole? Because here's the reality: elections don't just pick presidents, they pick winners and losers in the stock market as well. And the winners? It's almost always the already rich.
Mr. Shazib Kaim, I see your hand is raised. Would you like to add anything?
Yeah, yeah. Supreet, and I think like that was really well said, Supreet, and I totally agree with you. And that was really interesting because social media apps like Twitter, like which is now called X, and it was purchased by Elon Musk because he wants to have a really strong influence on what people see because media is a really big factor. And Washington Post is I'm pretty sure it was purchased by Jeff Bezos as well. So it really shows how these big characters want to have a really strong influence over the media because it shows like because they know how much of a powerful tool it is. And super that was also really interesting how like Elon Musk's his net worth skyrocketed as Donald Trump became president, and that's because like um, Elon Musk, he is one of the most influential, controversial, and polarizing figures in modern business and technology. And uh, sorry, my throat's hurting. But like the thing is, we could see how he also really wanted to fund and he really advocated for Trump's elections, because even on Twitter, as a person who really watches, he really goes through X and really follows Twitter and who's following the election, I could see how he really wanted Musk to win, and that's because, as Supreet had previously mentioned, is for his own financial gains. And oh yeah, sorry. And Elon Musk and Donald Trump, they're both really polarizing figures, and they both share traits that impact the economy, stock market, and financial decision making. So, like Elon Musk and Donald Trump have used social media to influence stocks, cryptocurrencies, and financial policies, which often creates market volatility. Like Tesla's stock movements are often tied to Musk's statements. Like as I was previously talking about how big of an influence media can have. Like for example, uh, a single tweet from Musk about Tesla going private at $420 led to a SEC lawsuit and wild stock swings. And his endorsement of Dogecoin caused cryptocurrency spikes, showing his cult like influence on retail investors. And for example, in 2021, Musk tweeted that Tesla would no longer accept Bitcoin, causing Bitcoin to drop 15% overnight. And as for Donald Trump, like Trump's policies led to a stock market boom, with the Dow Jones and S&P 500 reaching record highs. And in March 2020, Trump signed a $2 trillion stimulus package, which triggered a market rebound from pandemic lows. And Musk moves individual stocks and crypto, while Trump shapes broader financial markets through policy and economic stimulus. And like talking about the election that happened recently, like if since Trump returned to office, we could see lower corporate taxes, like Supreet had mentioned, and it could definitely benefit businesses, which would drive higher stock prices. And there'd be less ESG regulations. Energy companies, coal, and all stocks might rise as well. And like we could also look at the tariff and trade war risks. Like there could be possible China tariffs affecting supply chains and inflation, and there would also be more deregulation, which would likely boost financial, banks, and industrial stocks.
Thank you, Mr. Shazib Karim. And I also think that very important opinions and very important things have been brought up by our discussion over here today. And I think that one of the things that I believe that all of us are saying is that the many wealthy investors are using stock market gains as a way to favor themselves and as a way to make sure that the wealth is increasing. And we've talked about how the wealthiest 10% of the US own about 90% of all the stocks, and the bottom 50% own less than 1% of the stocks, meaning that they don't benefit much from the S&P 500's long-term growth. And then since stock prices tend to rise over time, those who already own stocks get richer while those without access to investing fall behind. So what's your opinion on this information? What do you think that the US government or the SEC or all governments around the world should do to ensure fair and equal practices for everyone in the stock market? I see Mr. Supreet Nagella, your hand is raised. Would you like to add anything, Mr. Supreet Nagella?
Hello, Mr. Araf Malik. Thank you very much. This was such an insightful question. And I believe, to be honest, for now, I'm sure that the system is quite rigged in favor of insiders and billionaires who know how to play the game. But it's definitely possible to change the rules, and this is only possible if the government step in and level the playing field. So, for instance, what can we do? I'm sorry, my internet is breaking. I'm unable to.
Yeah, I think Supreet was having some technical difficulties. Even I had some today, but I think that's all. That's all right. So just to chime in there, I think Araf, your question was very interesting, and even governments even governments ourselves themselves can't I don't think they can solve this problem. So I think one of the examples, I don't know if you guys remembered it, previously I mentioned that some of the SEC, the Securities and Exchange Commission in the US, their some of their top bureaucrats or some of their top directors were once ex Wall Street traders, ex Wall Street. They definitely have Wall Street affiliations, and I think that's rigged. Because if they have Wall Street affiliations, I think it's a double-sided argument. I see why SEC hires people with Wall Street credentials, because obviously in order to rule and impose regulations over Wall Street, you need to have people who understand how Wall Street works. I get that, but I think it's risky, because if people are involved with Wall Street, then obviously they will have insider people working, even though they might not have implications of it. Obviously, they're gonna have insider people. They're gonna have connections, which is why I don't think it's fair in that sense. I think Supreet's hand is also raised. Supreet, would you like to chime in there as well?
I could chime in if since I think Supreet is having internet issues.
Oh
So,
no, sorry, Shazib. Yes, my mic
okay,
was unfortunately not turning on.
or
Okay,
no worries. Go on.
so to start off, one major problem I introduced was the borrowing against stocks and a loophole that the ultra wealthy masterfully employ. So, a policy fix we could implement is to implement a minimum tax on unrealized gains and limit how much can be borrowed against stocks without triggering capital gains tax. Number two, higher taxes on high frequency trading. Large firms use AI and algorithms to trade in milliseconds, and this gives them an unfair edge. So, what's the policy fix? The policy fix is to impose a small financial transaction tax on every trade to reduce excessive speculation. Number three, wealth tax on large stock holdings. Billionaires can avoid taxes by never selling their stocks and passing them down to trusts. So, what's the policy fix? To introduce a small annual tax, maybe like around 1% or 0.5% on ultra large stock holdings above a certain threshold, maybe $50 million. Number four, making buybacks less attractive. Companies use stock buybacks to artificially inflate their stock price, benefiting executives and large shareholders. What's the policy fix? To increase the tax on buybacks and encourage companies to invest in employees and innovation instead. Number five. Number five is to close the carried interest loophole. Hedge fund managers pay lower tax rates than regular workers on their income. What's the policy fix? To add tax on carried interest profits from managing funds as ordinary income instead of at lower capital gains rates. Number six, transparency for private markets. A lot of stock trading happens in dark pools, like quote unquote dark pools, where big players make moves without public knowledge. So, what's the policy fix? To require real time disclosure of large trades and private transactions to prevent market manipulation. Number seven, implementing tougher insider trading rules. So, executives often sell stocks right before bad news drops to dodge losses while regular investors suffer. So, what's the policy fix? To add in stricter penalties for suspicious trades and longer lockup periods for executives. Number 8. Ending the pass through tax loophole for wealthy investors. Many wealthy investors shield income through pass through entities like LLCs or partnerships to pay less tax. So, what's the policy fix? To apply the same tax rates to investment income from these structures as regular stock income. And lastly, we must prevent AI and algorithmic market manipulation. So, what do big firms do? They use AI to manipulate stock prices by executing millions of trades per second. What's the policy fix? To implement speed bumps, quote unquote speed bumps, to slow down trading and require AI trading audits for fairness. So, Shazib, I'm very sorry for cutting you off earlier. Could you please continue if you want to?
No, no, Super, don't be sorry. I think that was very insightful, and I appreciate your comments. And I think like Arif's comments before yours, that was also really insightful. And to add on to what and to like talk about what Arif had initially asked about, like Arif had brought up the point on like what the government could do to ensure fair and equal practices for everyone in the stock market. And I think it's very tricky because like one of the biggest ways the stock market is unfair is through insider trading and market manipulation by hedge funds and institutions. And you know, executives and politicians often have non-public information that allows them to trade stocks before major news is released, and that's kind of like the asymmetric information that Ari was previously talking about. And hedge funds use high frequency trading algorithms to manipulate stock prices faster than retail investors can react. And maybe the solution to this could be to ban politicians from trading stocks while in office. And they could also have stronger enforcement and harsher penalties for insider trading violations. Like, for example, I believe that in 2020, US senators were caught selling stocks right before COVID-19 market crashes due to secret government briefings, and they faced no major consequences at the time, while retail investors suffered. And another problem is that large hedge funds engage in predatory short selling, betting on stock declines and forcing companies to fall. And I think the solution could here is maybe to require the hedge funds to disclose large short positions in real time and prevent institutions from over leveraging and crashing stocks artificially. And like for example, I think during the GameStop short squeeze, brokers restricted retail traders from buying GME, benefiting hedge funds while hurting small investors. And also, the richest 10% of Americans own over 89% of the stock market, while many lower income workers don't even have access to investing. And I think that's just crazy. And it kind of shows how big of a gap and how unfair this is. And I think the solution to this could be to maybe introduce advantage stock investment accounts for lower income Americans, and to maybe require companies to offer employee stock ownership plans, giving workers a stake in corporate success. And maybe also increase financial education in schools to teach investing, and that would also reduce reliance on payday loans and credit debt. Like for example, instead of instead of CEOs getting massive stock-based compensation, companies could redistribute shares to workers, boosting long-term wealth for employees as well.
Thank you, Mr. Shazib Karim. I believe that that brings us to the end of our discussion for today. The discussion topic was episode 36, Inside the Stock Market Engine, exploring the S&P 500 index fund with Mr. Supreet Nagala. Today's discussion, I believe that it led us to a good comprehensive understanding of the stock market and why it's important and how it sometimes is biased against the common man. And again, thank you to our guest speaker, Mr. Supreet Nagala, for coming into this episode. Mr. Supreet Nagala, is there any final things that you would like to say before we depart for today?
No, thank you very much for inviting me on such a prestigious podcast. And yeah, that's really it. I had a very insightful discussion with Mr. Shazib, Mr. Arib, and you, Mr. Malik, of course. Thank you.
Thank you, Mr. Supri Nagala, for your insights. And again, that brings us to the end of our discussion for episode 36. Our topic of discussion for today was Inside the Stock Market Engine, exploring the S&P 500 index funds with Mr. Supri Nagala. Mr. Supri Nagala, thank you again for your wonderful presentation here today. And thank you to the audience for chiming into and listening into today's podcast. And we hope to see you next week with another very interesting topic with another very interesting guest speaker. Thank you and goodbye.